business news, we're news for business people. Good morning. This is BloombergQuint's India's first live business news streaming service. I'm Menaka Doshi.
Mornings. I'm Pradeep Pandya. You're watching BloombergQuint.
Good morning. These are the headlines this morning. The IMF cuts India's growth forecast. China set to outpace India in 2017. India expected to grow at 6.7% now. Demonetization and GST may bring down growth this year, but a rebound forecast in 2018. Nobel Prize winner Richard Thaler says the stock market rally is making him nervous and investors may be caught napping. Another Nobel laureate, Paul Krugman, is not as worried but says there's a disaster risk that may not have been taken into account. Dena Bank launches a qualified institutional placement issue, testing the waters for equity fundraising by weak public sector banks. And the country's largest reinsurer, GIC Re, opens its IPO for subscription today.
Let's take a look at how markets are likely to fare today. Well, to begin with, SGX Nifty is looking strong, and if you compare that with yesterday's closing of futures market, because SGX Nifty is actually futures, one could expect an opening around 10,040, 10,050 mark. So that's going to be a strong opening. 10,070 and above are the levels that traders are actually looking at, where there could be some resistance. But look at all the other indicators that we're getting from global markets. Other Asian markets are also strong following the record closing in US, where a $20 billion buyback from Walmart had really energized the indices yesterday. If you look at Dow Jones and Nasdaq, S&P 500, they were all very strong. But we'll try and look ahead towards the end of the session and anticipate how US will do today. So there, an important FOMC minutes of meeting is expected, and market will probably try to preempt that. Europe was not that strong yesterday because of the uncertainties regarding Catalonia, so that could still hamper that market. But the cues for our market are going to be more from currency and commodities, because oil moved up once again. So that's a positive for upstream oil companies, heavyweight like ONGC. These are the stocks to watch out for in that case. Dollar index also softened a bit, so that could be again positive for commodities. And if you look at the currency market, rupee in fact tried to regain yesterday the lost ground against dollar, and that process could extend today with further softening in dollar index. Another positive for Indian markets. If you look at bond market, they are also giving you a positive indication today, because banks were trying to support indices yesterday. There was limited gain, limited to some private sector banks. There could be further buying interest in these banks if bond yields soften further. So that's another positive indication for us. If you look at yesterday's trade, in fact, among heavyweights, the buying and selling was kind of evenly dispersed, and that's why indices remained in a narrow range. Although FIIs are still not supporting one today, they remain the DIIs remain positive, and they are kind of trying to compensate for the selling that is coming in from FIIs. But once above 10,000, any further selling from FII is not a good news. The only good news that you could see yesterday was selective buying interest in stock futures. So there could be some interest in select sectors, and they will try and lead the markets up. In yesterday's trade, interestingly, we had RIL and Infosys trying to support. We had some banks like Axis Bank, HDFC, they were also supporting. But on the flip side, you had a heavyweight like HDFC. You had heavyweights like ITC and HUL. So which sectors could really lead? Today, going by these trends that we have seen so far, there could be support from commodities, there could be support from oil heavyweights, and there could also be support coming in from some rate sensitives like auto, for example. If they take a lead, that would probably help indices sustain at higher levels. Key stock to watch today, however, will be Coal India among heavyweights. After that historic agreement they have reached. But brokers are actually divided. The kind of reports that have come out from both local and foreign brokerages, some experts believe that there could be a downside risk to even the dividend payout. However, there are various brokerages who think that they will remain positive for Coal India. They are not worried about this agreement, and more importantly, there is enough demand pickup which will keep driving this stock up, and company will actually be able to pass on most of this increase in cost. The next stock is Dixon Technologies, which will remain in focus after the agreement with Flipkart. This is in fact a new entrant in the markets and has been doing quite well. This is a very strong positive for that. GM Breweries, we'll talk about this stock further, but excellent results, and Lumex Industries after a big investor buying into this stock. So these are some of the stocks. Mid cap and small cap will continue to remain in focus, looks like.
You know, I thought what was interesting about Coal India was a lot of brokerage notes seem to be just relieved that the news is out of the way. And I think almost everybody underestimated what the cost of this new wage pack would be. So it's come in above almost everybody's estimation, right? In some cases, almost twice some people's estimation. But they're just happy that the news is out of the way and that, you know, the company can move on now with that uncertainty.
So now you have a number to work with.
Now you have a number to work with, exactly, which is what the market is more comfortable pricing in than the uncertainty. So that's the story on Coal India. But that's not all we have for you today. A bunch of editorial stories that we'd like to put under the spotlight this morning. So on First Word this morning, we've got TCS and IndianOpen Bank that will kick off second quarter earnings in full earnest tomorrow. What can we expect from both of these sectors? That is the IT sector and the banking sector. We'll talk through that. Then we've got Dena Bank this morning looking to be the first of many weak lenders to raise funds from the market. But do investors have an appetite to take the plunge? And finally, IMF expecting China's growth rate to overtake India in 2017. No surprises there, but they have revised downwards both the annual rate for this year as well as for next year. What, according to the IMF, should India do to get its economy back on track? Well, that's the couple of $1 trillion question there. All right, let's get on with the first one, and that is earnings season. So we've got two nifty companies, both representing very important sectors and both surrounded by a number of uncertainties. Both of them will be reporting tomorrow. So we've got Agam and Shraddha standing by to do all the number crunching for you. Agam first, TCS is out tomorrow. What's the outlook on the IT sector?
Well, not very good, you know, because the weakness in the banking, financial and services sector persists. This is a continuation of what we've seen in the previous few quarters, and we're expecting that story to play out in this quarter as well. But let me start off with your basic expectations on your top line, your margins and your profitability. We're not really looking at too much. This is supposed to be a seasonally strong quarter for the information technology sector. So on the back of that, on a sequential basis, we're expecting a near 3% increase as far as revenues are concerned, and profits expected to see 2% uptick. But when it comes to margins, largely expected to remain flat, around 20.7% on an aggregate of the top 8 IT companies by market capitalization. What are the challenges that the IT companies have faced in this quarter? As I've already mentioned, the weakness in BFSI demand. But moreover, we are also looking at some problems when it comes to your transition to the digital service delivery, which is still a work in progress. So these are some of the other aspects. And of course, we're going to keep an eye on planned wage increases. This is something that has been factored in because this comes on in the second quarter every year. Moving in, what are the positives that we can keep an eye on? Well, because of the fact that expectations are so tempered in the first place, any negative surprise may not have a substantial impact on companies. Of course, we are expecting the weaker rupee as against the dollar to aid margins going forward. And the mid-cap IT companies are expected to do much better in comparison to its larger peers. And what are we keeping an eye on? Of course, commentary on the BFSI segment, but we're also looking at updates on digital transformation and automation. And finally, there is very low probability of an increase in guidance. However, should we see a very bad quarter for any of these IT companies, which we could see a downward revision of guidances, but that remains to be seen.
All right, thanks very much for that, Agam. Shraddha, what's it looking like for the banking sector?
Well, it's going to be more the case of same old, because we're likely to see the same kind of underlying trends that we have been seeing for the past many quarters for the banking system. So just a broad run through for some of the key parameters. If you look at credit growth, the system credit growth remains subdued at about 6.5% in the second quarter. So if you talk about retail growths, they remained resilient at 15 to 16% in Q2. So that some support should come into the growth momentum from retail loans because corporate loans continue to remain sluggish. Now, if you look at the asset quality, public sector banks again are likely to report a lower slippages number. That is, of course, compared on a sequential basis. Q1 also had a relatively higher base, but having said that, credit costs will continue to remain high, and that will weigh on the PSU bank earnings. When it comes to the retail and SME slippages that we had seen in Q1, some analysts are expecting some sort of a pullback over there, but agricultural loans, which came up as an issue in the last quarter, are likely to continue to remain under pressure. On the corporate loan side, analysts see some worry as far as the telecom sector loans are concerned. If you look at the treasury incomes, in Q2 we did see the 10-year benchmark bond yield rising 15 basis points. So all banks are likely to report a lower treasury income. But having said that, you have ICICI Bank and SBI, which are expected to report some gains from the stake sale in their general and life insurance subsidiaries respectively. And when you talk about the margin, the broader trend is that it is likely to remain stable for most of the banks on account of the combination of three factors. One is the cut in savings account rates, the other is the cut in MCLR rates, and thirdly also that the high NPAs will have a bearing on the margin. So broadly stable to negative is what the outlook for the margin is looking.
All right, that's the sector outlook, but do you want to break it down for us for some companies, some banks?
All right. So if you talk about individual banks, broadly the retail-oriented banks will continue to perform well. That's what we have seen for the past many quarters, while corporate-heavy banks are likely to remain under pressure. So if you look at the individual performance, the net interest income growth expectations, the same will be reflected. HDFC Bank, Kotak, IndianOpen, Yes Bank, all of them are likely to support, see a double-digit growth. SBI, of course, we haven't mentioned. This is going to be the second quarter when the bank reports the merged entity numbers. So on a sequential basis, we are likely to, analysts expect to the net interest income to fall by about 4%. When you look at the net profit picture, again, you see retail-oriented banks like HDFC, you have Kotak, IndianOpen, Yes, again, they're expected to post 20+ sort of growth numbers. When it comes to ICICI Bank, there's another factor playing here for this company. Now, in the last year comparable quarter, they had a stake sale in their insurance subsidiary, which led to gains of close to 5,600 crores. And in this quarter, they are going to have general insurance subsidy stake sale gains, which are likely to be close to 1,900 crores. And hence, that also has a bearing on ICICI Bank numbers. Bank of Baroda, again, we're expecting net profit growth to fall by about 12%. So broadly, what analysts are really going to focus on in this quarter is going to be what we're going to be watching for the quarter, the growth in home loan segment, which has come off in the recent past. That's one thing to keep an eye out for, especially for the retail oriented banks. The movement of stress assets, and of course the provisions that banks will be making on RBI's accounts in the RBI's list. Lastly, we're also going to be keeping an eye out for any comments with respect to progress in resolutions, and also any comments if they do come in as far as PSU bank consolidation is concerned.
Right, Shraddha, thanks so much for that. I'm just going to stay with banks for a brief minute longer. And this is about Dena Bank. Late yesterday evening, Dena Bank came in and said that they're launching their qualified institutional placement issue. Now, not a big headline from a QIP market perspective, but a big important issue to track from a weak public sector bank perspective. Just a brief mention of what the numbers look like. The floor price has been set at 30 rupees 73 paisa per share. They have a board approval to raise up to 1,800 crore, but I think they're doing a much smaller tranche right now of about 400 odd crore. A little more than that is what they're hoping to raise. Now, the Dena Bank is certainly not the first bank or the first public sector bank to go to the market. Vijaya Bank had raised 700 crore in August, and of course SBI had done a huge issue in June. But both Vijaya Bank and SBI are considered to be relatively stronger banks. So Dena Bank, in some senses, the first weak public sector bank to test the equity capital market, fundraising environment. They, if you want to remind yourself of what their asset quality looks like. They reported net losses in 6 of the last 8 quarters. Their gross NPA ratio is at 17.37%. Their net NPA ratio is at 11.22%, and they are under RBI's prompt corrective action. So, it's a brave set of merchant bankers who are taking this issue to the market. Let's see what kind of subscription it gets and whether LIC has a large role to play or not in the final fundraising scenario. The reason we're mentioning this is because if Dena Bank somehow sails through, and if you see demand coming in from non-LIC institutions, then you've got a whole host of public sector banks who are sitting on board approvals to raise QIP money. Union Bank, Bank of India, Central Bank, Bank of Baroda, all of them have board approvals in place, but nobody has gone to the market for the fear that they will not see demand coming in from institutional investors. In fact, the Reserve Bank of India has sort of been pushing these banks to go and test the equity capital markets. In a speech recently, Chhaochharia, the Deputy Governor of the Reserve Bank of India, had said, why aren't bank board approvals of public sector capital raising leading to immediate equity issuances at a time when liquidity is chasing stock markets? What are bank chairmen waiting for, he asked. The elusive improvement in the market to book, which will happen only with a better capital structure and could get impaired by further growth shocks to the economy in the meantime. So basically, the RBI is telling them, don't keep waiting for the government to come and give you capital. At least go and try and raise some of it on your own. So Dena Bank will be interesting to watch.
I wonder if investors feel as enthusiastic about capital raising as the RBI does for many of these banks. Let's add one more conversation into the slightly macro mix, and that's what the IMF had to say last evening. It has lowered India's growth forecast to 6.7% for 2017. No surprises there. It's about a 0.5 percentage point reduction from its previous 2 forecasts in April and July. It's attributed the cut in forecast to demonetization and the introduction of GST, that's the goods and services tax. The IMF has also lowered the growth forecast for 2018 for India to 7.4% from the earlier forecast of 7.7%. Now, interestingly, it's up the forecast for almost every other region, right? So US is up, Europe is up quite neatly, China is up. Both US and China, I think they've marginally increased the forecast. I think India is amongst the few large economies where they seem to be a lot less optimistic. No surprises there that they've even revised it for 2018. So I suppose they expect the lingering impact of both of these things to continue.
Reasonable recovery expected in 2018, which is what everybody's been saying. So yeah, no real surprises there.
But the big question, will be, given the kind of valuations we have, and all the central bankers are now talking about tightening, I mean, how would you really justify this valuation? Because if cost of capital starts moving up, equity markets will seriously be worried about growth. There has to be significant bump up in growth, going forward to justify the valuation and justify any further buying.
Now, well, that's the question we've been asking for many quarters now, and it's just the liquidity that seems to be supporting it, or maybe, if Rhythm's listening to this, he'd not necessarily call it liquidity and call it something else, but it's just the money coming in that seems to be supporting this at higher and higher valuations. So till that tap stays open, anybody's guess.
The low levels of volatility in the stock market have caught the attention of this year's Nobel Prize winner, Richard Thaler. He says that the stock market seems to be napping the riskiest moment of our lives.
Well, right this minute, I think the minuscule volatility in the stock market, not that I have an explanation for it, but it's certainly puzzling, and it's puzzles. We seem to be living in the riskiest moment in our lives, and yet the stock market seems to be napping, but being pushed up by some snail. I don't know about you, but I'm nervous. And it seems like when investors are nervous, they're prone to being spooked. And nothing seems to spook the market.
All right. Now, Paul Krugman, on the other hand, doesn't necessarily see a bubble, but believes that there may be a disaster risk that's not being taken into account by investors. Hear him out.
Profits are high, interest rates are still very low, so it makes kind of sense for stock prices to be high given that. It's more, in this case, I don't see it's a really overwhelming bubble. I just think that there's a disaster risk that the markets are not taking into account. I am a little surprised that the market doesn't worry more about the downside of a totally catastrophic response if something bad happens. What if we have something really bad happens and they handle everything the way they handled Puerto Rico? That ought to be some kind of weight on the market, but we know that markets tend tend to ignore those things until they actually do happen.
All right, two slightly contrasting views from two Nobel laureates there, and might I point out that most of them have mostly to do with the US markets or global markets. Well, that's all we have for you on First Word today, but stay tuned to BloombergQuint. In just a bit from now, we discuss second quarter earnings expectations with Gautam Chhaochharia of UBS, the government's Power for All goal with NTPC's Kulamani Biswal. On IPO Adda, we've got Alice Vaidyan of GIC telling you about what the future plans for the insurer is, or the reinsurer is. And then we've got a revival in the country's core sector. That's the question we're going to put to AK Garg of L&T Construction and Mining. So a bunch of corporate voices coming up over the course of the next hour or so. Stay tuned as we continue in IndianOpen.
And now let's talk about derivative market. Navneet Saluja is standing by with the FNO setup. Navneet.
Hi Pradeep, good morning. Well, finally, Nifty closed above the 10,000 mark yesterday after struggling for two straight sessions. But looks like the bulls and the bears both have been fighting for that mark. If you look at the Nifty yesterday, open interest was up about 2.5%, and the premium actually came down a bit to almost 19 points. It did indicate there were some fresh long positions which were being taken above the 10,000 mark. Let's also pull up Bank Nifty, which actually broke away from the range. Bank Nifty yesterday closed at levels of 24,374, and if you look at the open interest, no major addition seen there. That was up almost 1.4%. But the good point is that the volatility has been coming down in the past few sessions. We've seen the VIX going up to levels of almost 14, so that's come down to around 11.1, which is actually a good sign. But going to the Nifty PCR now, 1.39 was the PCR yesterday, and remember, this is the highest PCR that we've seen in the October series, and that's precisely on back of a lot of put writing that one is seeing in the system. Even for the Bank Nifty Bank Nifty PCR, that rose to levels of about 1.29. So which are the strikes that is driving the Nifty PCR higher? Let's look at them. The most active strikes yesterday, 10,000 call added about 1.8 lakh shares. But I'm talking about the put strikes. There's a lot of open interest addition being seen there. So yesterday, 9,900 put as well as the 10,000 put strikes saw addition between 6 to 4.5 lakh shares. And if you look at the options premium on both the 10,000 call and the 10,000 put, we've been highlighting for you in the last two sessions. Total premium comes to about 170 points, so indicating the range for the market will be in that range. So it could be about 99.30 on the downside to about 10,100 on the upside. And what actually the options data is suggesting that the support for the market for both Nifty and the Bank Nifty has been going higher in the last 2 to 3 trading sessions. Let's see then what the FIs are doing. They continue to sell in the cash segment, and yesterday they unwound some long positions on the index futures, and on the short side they added a little bit of contracts. The net long positions have also come down to 57% versus 58 that we're seeing in the previous session. In terms of options data, well, clearly there was some buying seen on the call side, but majority of the buying came in with regard to put longs, and some sort of writing was also seen for the put shorts. Now remember, even the client data is suggesting the same. In the last few sessions, we've seen the clients, which is basically the retail and the HNI clients, they too have been buying a lot of puts and writing also puts, clearly hedging themselves. In terms of stock futures, just keep an eye on stocks like Hexaware. That counter was up yesterday. Look at the open interest build up, almost up 30%. Besides that, you also had stocks like Havells, which did well. And besides that, Stride Shasun was the other one which rose from the pharma space. Clearly open interest suggesting that there was some sort of long build up coming about there.
Well, thanks, Navneet, for all the details. Abhijit Pathak, Director at Define Edge Solution, joins us now. Abhijit, good morning. How do you plan to trade Nifty today?
Yeah, it seems there will be a gap up in Nifty, and at these levels it is a bit risky to go fresh long. It is, I mean, you have to just trail the original longs from earlier. And the support has moved up every day, every couple of days, and now it is near 10,000, or worst case 9960 on the Nifty futures. So as long as that holds, Nifty is still in an uptrend, short-term uptrend.
Okay, so you see a short-term uptrend continues, but what are your favorite bets today? Any stock that you like on long or short side?
On the short side, no, there's nothing which is going weak except ICICI Bank. But then at the same time, ICICI Bank is at the 200-day moving average. So going short at the 200-day moving average will be risky. It is better to wait for it to close below 268 before going short. So if it bounces, it can give a good bounce as well.
And on the long side, you have a trade today?
Yeah, one trade which I like is ONGC. If it is available near 169, 170 futures with a very tight stop loss of couple of rupees, 167, 168. ONGC can go to 173, 174, and beyond that, you can see a big rally in ONGC above 174. It can go to 180, 185 also.
Okay. Biocon was an interesting stock in yesterday's trade where the news flow was not so positive, but stock moved up quite a bit with interesting additions on the long side, I believe. What's your take on Biocon?
Biocon is quite bullish, and if it crosses 370, 372 in futures, the next resistance is only above 380, 385. So that also can be a good 15-point ride above 370, 372 in futures.
In fact, focus remains on the mid-cap space, and there are two stocks actually in IT sector which were in focus yesterday. Hexaware, we saw roughly 30% addition, and NIIT Tech also saw some 12% addition. The sector will remain in focus because tomorrow TCS is going to announce the quarterly numbers. What's your take on both these stocks? And maybe if you like something else, please do mention that.
NIIT Tech has broken out above 600, so as long as it is above 600, the uptrend can continue. So in a sense, if anyone is long in NIIT Tech, he can use a stop loss of below 600 in futures. Whereas Hexaware gave a good bounce yesterday, but it has a resistance at 285, and above 285, it can again give a fast rally. 285 futures in Hexaware.
So do you see some support for South Indian Bank coming?
South Indian Bank, there is a support near 27, 28, and that can play. And as long as 27 is held, it can give a bounce. And but then I would not go let it stabilize first, because it was a big, almost more than 6% fall yesterday. So it is very unlikely that it will recover all the 6% immediately. So it doesn't make sense to go long immediately. Let it create a base near 27, 28 and then go long.
Okay, thanks a lot, Abhijit, for taking time out for us this morning. And let's move on now and look at how SGX Nifty is doing. 10,072, 73 is what I see there. Roughly a gain of 40 points for Nifty expected if we follow the cues from SGX Nifty. Look at other Asian markets. They are flat to positive, whether it is Hong Kong or Shanghai, Japan. So that is the cue. Flat to positive signals from Asian markets. And now, joining us in the studio is G. Chokhalingam, founder and managing director, Economics Research and Advisory. Good morning.
Good morning.
So how do you really see markets now that we are, once again above 10,000 mark? Are you able to find interesting stocks in this market as well?
Yeah, certainly. Any market you can always find some value stocks. But overall market size gives some worry. More than index, today the entire market cap of BSE listed stocks is a little more than 136 trillion rupees. Nearly about 33 trillion rupees is added since March 2015 when Sensex hit 30,000, and primarily by small and mid cap stocks. My biggest worry is that many mid and small cap stocks now today are marketed at 30 PE on 1 year forward earning. So a lot of people have suddenly found FMCG, MNCs in the small and mid cap space. So that is the biggest worry. But otherwise, I do not have any fear on the overall benchmark indices like Sensex or Nifty. If at all there is a correction, they may fall only 2-3%. But there could be a steep correction, possibly in the mid and small cap space where many individual stocks are overvalued.
Okay. Well, one of the key heavyweight we'll be watching out for today, and because like we saw in yesterday's trade and also over last 2-3 sessions, it's quite stock specific, even within the index. So the index opens up and holds on to a narrow range, but can't really move up. So they're looking for, kind of leadership. So whatever happens to a heavyweight can have a bearing on overall index movement. Coal India is the one which is in focus today. How do you look at the wage revision? Will they be able to pass it on and you'll remain positive on it?
Certainly. If you look at the last 2 decades, this is not the first time. Every third, fourth year they have been rising, because it's a PSU and it has got a strong trade union. So the Coal India has been facing this problem, roughly every third, fourth year, and it has been growing its profit. So there can be some dip in 1 quarter, but they will soon revise the prices, because let us also not forget the fact that the domestic coal prices are much, discount to the international prices. So there is a lot of headroom for revision upward. and still it is sitting on tens of thousands of crores of cash. I am expecting, considering the government's stress on the fiscal balance, there could be once again a special dividend. So that can lift the stock.
So that's the worry, you know. One of the brokerage report that I read this morning says that if you compare the total cash balance that the company has got and the incremental burden due to this agreement, you're covering 3 lakh employees, and you know the overall burden is somewhere around 5 to 6,000 crore. That would take away a significant chunk of your cash, and unless you're able to replenish, you may not have scope to give a special dividend, and we do buy these PSUs for high dividend yield, right?
That argument is, in my view, logically invalid for 2 reasons. Because it makes profits more than this 3, 4, 5,000 crore. So the burning will come on the operating profit, not on the cash held by the company. And as I said earlier, this company is known for revising the coal prices upward every time they rise the wages. So therefore, the existing cash will not be depleted. So therefore, still the company would be in a position to give a special dividend. That's my strong conviction.
Okay, we were talking about Dena Bank this morning, and you know what is interesting, the stock is now quoting around 30-35 levels. 3-4 years back, you know, before all this NPA disclosure process started under Raghuram Rajan, the stock has seen 115, 120 kind of level. So we are at 1/4 of that price level, so to say. At this juncture, the key promoter, that's government, not infusing incremental capital and rather asking market to participate. What kind of signal does that give out to a private investor? I mean, if at this valuation, the promoter is not willing to chip in, why should I?
Yeah, promoter is himself in a deep trouble because the first half of current fiscal deficit almost equivalent to the targeted deficit of the full year. So it is very difficult to expect the government to support, which means you know, the consolidation is unavoidable. So the weak PSU banks like Dena Bank, they have to be merged with a larger bank. And the biggest advantage for this kind of bank is that they are regional specific. So there are a lot of national banks which would be interested in merging a bank like Dena. So therefore, I believe you know, eventually this consolidation would happen. And as far as the investors are concerned, they should bet on you know, few select PSU banks. The criteria should be the price to book value, net NPA percentage. It should not be more than 3-4%, and price to adjusted book value should not be more than 2-3 times. And they should be able to still grow the business. The biggest concern for PSU bank is that many of them are degrowing the business. So if your business is degrowing and you have an NPA problem, then there is no solution. So therefore, these are the 3 criteria the investor should look at and select 1 or 2 good banks within the PSU space.
Okay. In fact, you know, if you look at all the previews, that is the big question. How is market positioned ahead of this earning season? Is that we are overweight on private sector banks and NBFCs and underweight on PSUs. Whereas probably, you know, the whatever growth number the NBFCs or private banks can post, market already knows about it. Could there be a positive surprise here on? Very difficult. But could there be some positive surprise coming from PSU banks in terms of additional slippages or incremental provisioning? And could that really you know, lead to an upgrade? Do you expect that?
No, very difficult. The expectation is that you know, the NPA for PSU banks would peak out only by March quarter. It is unlikely to happen in this quarter.
So even if the slippages slow down,
that can happen. You are right. That can happen for 1 or 2 banks which are better positioned, say something like a Bank of Baroda. Relatively, it is in a better position than many other PSUs. So 1 or 2 cases, you are right, it could happen. But majority of the cases, I think the pain would continue. So, and also as far as private bank NBFC concerned, today, you know, the market has been hijacked by the retail investors. The insurance companies are not investing heavily, FIs are not investing. Only the retail money is pouring, and you know, that is why you are seeing abnormal.
So since you talked about you know, picking up some of the PSU banks, so Bob is one.
Yeah, definitely. Bank of Baroda is a one.
Any other name?
I have not looked at other banks because I am heavily focused on old private sector banks.
Okay. Anything you like there?
Definitely, we like South Indian Bank. Because you know, I am not worried about the results yesterday. There is a 250 crore one-time provision towards you know, the asset reconstruction certificates.
What they sold in March.
Yeah. And the most important point is that operating profit as well as the business, they have grown in double digit, which is very rare in this scenario, apart from the large private banks. So that gives me a lot of confidence, and also the valuation. Even after this spurt in NPA, the price to adjusted book value is only 1.5 times, which is one of the cheapest in the private sector banking space. So therefore, I would still suggest
Okay, so South Indian Bank is what you like, and also Bank of Baroda among PSUs if you have to pick one. Well, let's move on and talk about PSP projects. The company has bagged a new order worth 1,575 crore rupees from Surat Diamond Business. To discuss the contours of the deal in further detail, joining us on the phone line is the Chairman and Managing Director, P.S. Patel. Mr. Patel, good morning. Could you give us more details about this order?
So this is the project is going to be construction in Surat, known as Diamond Bush, where all customers are the diamond merchants, and it is going to be 65 lakh square feet of building and one plate. We call it, they claim that this is the Asia's largest project at single plate, and there were about 6 to 8 companies who applied for this order, and finally we got this order of 1575.
And with this order, how much does your order book currently grow, and where does it stand?
So till September end, our order book outstanding was about 1,100 crore plus this 1575. So we can claim this is 2,700 crore order book outstanding of September 2017.
And you expect this order to be completed in 30 months. So when can we expect this order to start reflecting in your books of account?
See, because this is a large size project, so probably we'll be starting after Diwali. So we expect about 150 to 200 crore because the initial stage acceleration and all that processes take time. So we expect up to 150 to 200 crore revenue to come from this project before 2017.
Okay. Mr. Patel, but would you induct a partner to execute this project, or you will be in your individual capacity be able to execute it?
No. We will be executing this project on our own individual capacity.
Okay. Thanks a lot, Mr. Patel, for joining us. So that was PSP project. But there are many more stocks to watch out for this morning, and our research team is joining in as usual to talk about all those shares. And let's begin with the stocks in news. Top stocks in news, Shraddha. What is it?
Pradeep, 2 QIPs which opened yesterday. One is Dena Bank, where they're looking to raise about 400 crores. They've set the floor price at 30.73 per share. And you also have Bodil Chemicals. They're looking to raise about 225 crores. They have set floor price of 174. That's a 3 to 4% discount to yesterday's closing price. You have Dixon Technologies, which has entered into a design, manufacturing and supply agreement with Flipkart. Now, this is for TVs, washing machines and other appliances as well. They haven't disclosed the financial details of this agreement. Nevertheless, it is a positive for this recently listed company. So we should see some positive share price reaction as well. PSP Projects, they've bagged an order worth 1,575 crores from Surat Diamond Business. The company's current market capitalization is close to that 1,500 number. So definitely a positive reaction expected there as well. And you have Bharti Infratel, where there's a Times of India report which says that a global consortium of investors, which will be led by KKR, they are trying to help Bharti Infratel acquire Indus Towers. So basically, Bharti Infratel is looking to increase its stake in Indus Towers. Currently, it stands at about 42%. And lastly, we are also tracking Lumax Industries, where renowned investor Ashish Chhaochharia bought 0.7% stake via bulk deal yesterday. The stock has already moved up about 5 to 6% yesterday, but given the name involved, it won't be surprising to see further positive reaction today.
So a number of mid-cap stocks to work with, but Nikki, you are looking at a heavyweight.
So Coal India has signed a memorandum of understanding for a national coal agreement, which is for a period of around 5 years. The estimated impact on an annual basis is expected to be in the range of 5,667 crore. Now, we have various brokerages view, but then they all agree on one point, which is that the agreement, the wage agreement signed is much higher than what has been estimated and provided for. Morgan Stanley and Coal India says that it is underweight on the stock and expects a downside of nearly 23% from the current levels for this stock. It says that the wage hike settled at to 2x the provision, more than what has been provided for. And the management is expected to lower the impact in the medium term by various cost optimization methods. It expects a cash flow outflow of nearly 8,000 crore in FY18, which forms nearly 26% of your FY17 cash balance. And this implies a downside on FY18 dividend payouts as well. The other brokerage, JP Morgan on Coal India, it says that the company has materially underperformed the stock, has underperformed its peers, and is expected to catch up. It maintains a neutral rating with a target price at the rate of current market price. Final wage agreement would require large price hike to pass on the cost. It says that sales volume of 600 MT implies a price hike comes to around 95 per ton, and additional, it makes an additional point there. It says that additional gratuity burden is yet expected to hit the financials of the company. It says that the stock is expected to trade higher given that the wage cost is behind, and the annual large dividend expected to be announced in the span of next 3 to 4 months. Motilal Oswal, fairly bullish. It says that the worst is behind us. It says it has maintained the buy rating on this counter, hiked the target price to 335 from 305 earlier. It says that this wage hike will impact the earnings in FY19 by around 6% odd. It says that the average hike could be in the range of around 22. It says that the wage hike agreement was around 22%, which is way higher than the estimate of around 18 odd%. For the trigger behind the re-rating could be shutting down loss-making mines, cost optimization, and price hikes. So net-net, everybody is saying that the wage hike is more than what has been estimated, and only a price hike or going in the future can offset this kind of impact that could be seen on the financial.
But at least we know how much is it, and we have a number to work with, really. Agam, you are focusing on Tata Steel.
Yes, we have a brokerage note coming in, and they have also increased the price target. So Deutsche Bank has maintained a buy with the price target increased to 870 from 848. Two reasons. First is that they're expecting their EBITDA to improve substantially. In fact, they're looking at a volume growth of around 14% over FY18, FY19 CAGR, and because of that, they could see a big jump in EBITDA. And in fact, they're also looking at in India capacity, which could double in the next 5 years. I also have a note on Cochin Shipyard from ICICI Direct, and again, that's where they have initiated a call on Cochin Shipyard. They're also looking at a price target of 725, and here again what ICICI Direct is saying is that because of the fact that they have shifted their focus into shipping repairs, that is much more profitable, and that is the reason why they could see a substantial increase of as much as nearly 18% CAGR on its revenues over FY17 to FY20. There is only one snag here, that their cash flows could remain negative for the next couple of years. However, the dividend payout policy is very strong, and that's the reason why they are also positive on Cochin Shipyard.
Okay, and coming to Darshan at the end for a change today, what have you picked up?
See, the results season have started. One of the important numbers that came out after market hours was GM Breweries. One of the best run companies in the liquor space. It basically is into domestic alcohol. It got hit severely impacted because of the liquor ban, and for the past few quarters we've seen a decline that's happening as far as the sales growth is concerned. Now, obviously it's on a low base, but the sales has managed to rebound. EBITDA has come back to levels of 25%. A lot of cost optimization has been done. It's one of the cheapest companies in the liquor space in terms of price earning. Debt-free company, cash-rich company. So again, there is a lot of traction, but it was basically hit by the liquor ban that was there. Employee cost was declined, cost optimization. So the earnings season is good for GM Breweries. I should react in the positive today.
Well, thanks Darshan, Shraddha, Nikki and Agam for all these details. Mr. Chockalingam, I don't know what's your view on liquor per se, but do you like GM Breweries or anything else in this space that you would like to pick up?
GM Breweries has, multiplied a lot in the last 2-3 years, and maybe another 10-15% upside is possible, but I would not become overly bullish on entire liquor space because the sugar cane prices have gone up, even the molasses prices have gone up, and many states are becoming very rigid in promoting alcohol. We have seen the uprising of society in states like Tamil Nadu already. So therefore, one should trade cautiously in the liquor space. That's my view.
Okay, so you'll be cautious on liquor sector. Vishwesh Chauhan, Head of Quantitative Research at Monarch Net Worth Capital, joins us now. Vishwesh, good morning. Looks like we'll have a strong opening, but suppose we open around, say, 10,070 on futures or 10,045.50 in cash. How would you take it forward?
Good morning, Pradeep. See, the way I am looking at it is right now you are at a very cusp and you are just 100-150 points away from the highs. And now the fall had the signature which was indicating that that could be a sort of a corrective signature and it could go further down. So the way we are recommending to our client, we are definitely not suggesting aggressively buy, at least in the large cap space and especially the leverage ones. What we are recommending is that you need to have some sort of a cushion in terms of an option. So on Nifty, if we open around 10,040, I think you have to give 60 more points for a 10,100 to be taken out. And what you should do is you should start forming some sort of a ratio spread strategy on the Nifty. So buy 10,000 put and sell 9,800 put. Your net debit is only 15 rupees. So your break even comes around a 9,985. In my opinion, before an expiry, one dip towards the 90 head looks very imminent at this moment. So I think the Nifty will try to hold its ground above 10,000. That should be the good signal for the bulls, but I think the structure is definitely not as strong, because if you look at the Bank Nifty is quite lagging, and that is a divergence between two benchmark indices, and somewhere Bank Nifty is clearly indicating that this pullback may have a one leg pending on the downside. So we are not very gaga about the pullback.
Vishwesh, I understand that you focus more on F&O stocks, but if you look at the broader market, look at the kind of market breadth we have seen, look at the number of stocks hitting new highs, number of stocks hitting upper circuit, over last 2-3 sessions. Index is definitely, in a range, and there is limited interest or there is churn. But the broader market is looking extremely bullish. So what really makes you cautious here?
See, we have seen a couple of times in past that when interest rate declines and against that market tend to perform for a couple of months. So we ran one of the back tests that when the interest rate comes down, and after that in a scenario, what happens to the stock which is having the high dividend yield and what happens to the stock which is having a lower dividend. So we have found that positive expectancy of the stock which is the higher dividend yield, at the same time their drawdown tend to be lower. And what happens is that post 30 or 45 days or 60 days max, the overall market tend to give up all its gain, and when the fall comes, it is very severe. Now over here, there is one more thing which is cautioning to me, is that last year post budget, when we went higher for 27 week, and after that the decline was around 16 week. From that low, somewhere around December, post demonetization, the rise is exactly 27 week, and high made in August is cyclically high, and as long as that high is not taking out, I would not want to venture out too much into the cash. Also, definitely there is some stocks you would want to buy in the portfolio and it can perform, but it is good idea to remain cautious, because when the tide turns, you would never know that who is swimming naked.
Okay, so this could be a short-term move up, but also maybe a pullback when you have a medium to longer-term perspective. Vishwesh, in that case, take us through your strategy for the day.
So what we are recommending to our clients, and we've been recommending that for quite some time, and I've been speaking through your channel also, that you need to have an exposure in terms of the index which takes care of the downside if there is something. So it's like a buying up insurance, that you pay a marginal premium in terms of taking your safety. So while you have some stocks which is looking extremely good in terms of charts, in terms of the fundamental, in terms of the story, and they are moving high, you buy them, but at the same time you need to have some sort of a cautious approach right now, as long as we do not take out the highs in terms of the options. So right now the way spreads are looking, it looks either you form some sort of a short theta strategy which will give you some credit strategy and range, and in order to take an advantage of the range 9,800 10,000, you are right now slightly trading at a higher end of the range. So buying a 10,000 put and selling a 9,800 put, and that is in a 1:2 ratio, that will give you just a debit of a 15 rupees. So your break even becomes a 9985, and in my opinion a 100-point move, this 15 rupees can go higher till 30 rupees or 40 rupees also. So against your cash long, probably you may want to create this sort of a ratio bear spread for hedging purpose. So that is what we are recommending to our clients.
Okay. So before we talk about your stock picks, Mr. Chhochharia, one stock that we should be looking at is Lumax Industries. Do you track it? You have Ashish Kacholia, a big investor in a smaller stock. Normally, it leads to smart moves. And also, in fact, over the last 2 days, we have been highlighting this every day, that there is significantly above average volume action in auto ancillary sector.
It's a great company, no doubt about it. But if you look at auto component stocks in the last 2 years, most of them have multiplied. Anywhere from 200% to as high as 500%. So I am not comfortable in chasing them, after such a massive rally.
So you like nothing in auto ancillary?
No, we like still some tire stocks like MRF.
Okay.
But otherwise, we made a lot of money for our clients in many auto component stocks, and we shifted our focus away from this segment now.
Okay. Vishwesh, what are the stocks where you could go long today?
See, I think Pradeep, since last 3-4 weeks, we've been recommending only one stock to our clients, and for the simple reason because we get a lot of comfort in terms of the dividend yield. While I'm saying this again and again, because we have found in our test, testing the data, that when the interest rates fall, stocks with a 7% yield tend to have a drawdown less than 10%, and in a year or in a 1.5 year, it tend to double also. So Coal India is an excellent stock, in my opinion. We've been recommending from 240 odd level. In my opinion, a 1 year target should be double, but in a shorter term, what we are recommending is 320 rupees target. So that is the one stock which we are comfortable at this stage also. Other than that, I think in a leverage space, you may find this stock a bit odd, but the structure and the data looks very lucrative, at least from a short-term perspective, is the Suzlon. Suzlon around a 15 rupees, and yesterday's session it has given a first indication, then probably around a 15 rupees, it may have formed some sort of a short-term bottom, and probably it could give you that 15-20% quick rise. So if somebody is an F&O trader who would like to buy a Suzlon in the future with a 15 rupees 50 paisa stop loss, then probably this is the one stock. We have recommended to our clients around 15 rupees 50 paisa, but we are still bullish on the stock. It can go higher till 20 rupees. And the last stock is the short on Jindal Steel. Somewhere we have a reason to believe that dollar index could have bottomed and probably may start going higher. So somewhere this play of the metal parity compared to euro may turn out. So in that space, Jindal Steel has given us some sort of a short-term indication that around a 165 there could be a short-term top in place, and probably it could correct a 10-odd%. So short Jindal Steel with a stop of 165, target could be 140 on the downside.
Okay, so Vishwesh wants to go short on Jindal Steel or JSPL when, in fact, Deutsche Bank has hiked the price target on Tata Steel. So is it just a short-term move? What is really the fundamental view for medium to long term? We'll talk about that with Mr. Chhochharia. But for now, it's time for Bloomberg Edge, our special segment. And Jayesh Khilnani has an insight on the charts of HDFC Bank. Jayesh, what's there?
Morning, Pradeep. HDFC Bank, the stock has been in a very narrow consolidation range for about 8 odd days, and the fear and greed indicator is now suggesting that it is likely to move upwards. Now let's have a look at what the fear and greed is actually. So it uses the concept of average true range, and it calculates the spread between two of them, and it also oscillates between on a zero baseline. So anything above 0 is green and anything below 0 is red in color, and that's how your buy and sell signals are also generated. So you buy when fear turns into greed, and you sell the other way around when greed turns into fear. Now let's go back to the chart of HDFC Bank that we had on the screen. Now the bottom panel shows you the fear and greed. You can see that it is oscillating between red and green. And in fact, as of yesterday's close, this last green bar that you see, that is where the fear and greed has turned positive, indicating that there could be more upside and HDFC Bank could move out of that consolidation range.
Okay, so looks like now the fear turns into greed. There is more buying than selling at this counter. Have you tried to assess the strike rate or accuracy of this indicator?
Yes, Pradeep, in fact I did, and fear and greed turns out to be a very good indicator to follow for HDFC Bank. So in the last 1 year, if you had followed all the buy and sell signals generated by fear and greed, the net profit that you would be sitting on would be in excess of 50%.
Okay, so excellent risk-reward ratio here. Thanks a lot, Jayesh, for this call. HDFC Bank is the one we are discussing today. And, well, we were talking about metal stocks. And Mr. Chockalingam, Tata Steel target hiked, but there could be some peaking out in JSPL, technically what Vishwesh has figured. So there could be short-term corrections. But medium to long-term, what's your view? And what kind of results do you really expect? Because we have seen metal prices going up. And of late now we see, in fact, while the probably selling price is protected by anti-dumping and all, on the other hand, the raw material is getting cheaper for these companies.
Yeah, certainly. I mean, it is partly reflected in the price. But I am not worried about the steel stocks like Tata Steel. It may not fall badly. Still, there could be 5 to 10% upside. But I am more worried on other metals, ferrous metals, like zinc, copper, aluminum. From 2006 January lows, these metal prices have gone up as much as even 120% in case of zinc.
Correct.
So, if you see the last 2 decades of history for both metal prices and metal stocks, they never grown in a linear fashion. They always had massive cycles. So the stocks also from the bottom, they have gone up anywhere from 200% to 400%. If you take Hindustan Zinc, 2-year low roughly was around 116. Hindalco was in a double digit and Vedanta also double digit. So I am advising my clients to book profits in the metal stocks and move away from this space.
So we have been talking to some of the global commodity experts, and they are of the opinion that there could be short-term correction in these prices, no doubt about it. But even for next year, 2018, the demand and supply equation is quite in favor of demand. Probably there is not significant supply coming in. So a meaningful correction or a reversal in this cycle is not something that most analysts will actually agree upon.
But I am very fearful. I will give you one more data point that, all of us know that China is a major consumer of commodities. And unanimously, the global institutions are predicting a dip in the growth in 2018 for China, as low as 6.4%. The other economy, the fastest growing economy is supposed to be India. And all of us know what is happening for the growth revision. And today we have seen 4 international institutions revising downward India's growth. So 2 super nations in terms of the growth rate, when they are going through correction in the GDP growth. And on the other hand, many metal companies have announced expansion. Like a couple of days back, we saw the Vedanta Group announcing, talking about expanding the business, the capacities in Africa. So I feel it will meet the logical end in the sense the new capacities will be opened up, or the shutdown mines will be reopened. On the other hand, the demand should start slowing down. In fact, there are news that the zinc users, they are unable to make a profit by buying zinc at a current price as an input. So therefore, I believe that I am not saying today, tomorrow, but within a few weeks or few months, I think they will peak out and start correcting substantially.
Okay. Interestingly, if you read some of the research reports on these base metal stocks, you'll also realize that the price assumption that most big analysts have taken is 20 to 30% below the current market price. So there could be possibly a correction, but the valuations that analysts are really talking about and basing their projections on are actually already far below the current market price. So this is an interesting play going forward. Well, you talked about JSPL, that is just one stock in metal space. Vishwesh, anything you like in base metal? I mean, any kind of trade you see there, long or short, Hindalco, Vedanta, Hindustan Zinc?
See, I think, Pradeep, you have to start looking them slightly from a longer term perspective, because somewhere I feel that this stock, in spite of market not performing, from a 2016 low, Vedanta has gone from 60 rupees to 250 rupees. I am sure there must have been a strong fundamental result, but somewhere the prices are more leading in nature. And if you have an insight into an economics in terms of what happens to a global prices, you would probably, on top of metal stocks at least going higher, for the simple reason because the dollar parity helps them, and also the raw material prices was not performing. Now prices are indicating some sort of signs that there may be a cause of worry, or probably there may be early signs of a profit booking. Now I have found in my experience that it is always a good idea in terms of the metal stocks to exit out early and miss out last 5-10% in the case of metals, levels, because the day when Nifty starts correcting 200-300 points, this stock's butchered out, and it can leave your F&O position very brutal, in my opinion. So now to say that what is my view on a Vedanta Hindalco, I think the recent rise in Hindalco from a 250 to 250 rupees, in my opinion, that is again a corrective. So probably it may have a chances of forming the double top around 250 odd rupees. Talking about a Vedanta, again the fall from a 330 to 290, this rise in last 7-8 days looks corrective. So overall entire metal stocks is right now giving me a signature that after a fall, rise is right now happening, because the market is also pulling back, and this rise could probably a wave B or wave 2 pullback, and when the wave C comes, it could be brutal. So that is the reason I would like to be on the back foot. So at this moment, I would not want to venture out into the metals. Probably I would want to buy mining companies which are available at a valuation which is reasonable, higher dividend yield, and probably moving from a low, so like NMDCs and Coal India. So deal could be short metals by mining stocks.
Okay, that's an interesting trade here. Well, both our technical and fundamental analysts kind of agree that this is time to exit base metal stocks. To talk about some of these smaller shares actually that have been in news today, Mr. Chokkalingam, if you track say Dixon Technologies or PSP Project, there is positive news flow.
PSP Project I haven't tracked, but I definitely have analyzed Dixon Technologies. I am not able to, digest the kind of valuation the company enjoys being a contract manufacturer. In fact, I made a comparison with Whirlpool, which is into durable manufacturing. Interestingly, the Whirlpool has got a much bigger business, and it has got much better balance sheet, and it has got even free cash of around 10 billion rupees, but it is substantially at a discount to Dixon Technology. So instead of buying Dixon at this price and valuation, I would rather suggest looking at Whirlpool.
Okay, so that's a better idea. Now, market pre-open session is about to start. We are getting first quotes now: 10,039, 10,030, 10,028. 10,030 again. So market is trying to find a level, and in the meantime, Sensex is up around 17 points. To look at some of the key stocks that we'll be watching out for, Coal India should come on your screen. The first one, where we have a number of reports coming out this morning after the wage agreement signed by the company yesterday. The stock has opened almost flat. What about Tata Steel, where Deutsche Bank has hiked the target price? Let's have a look at that stock as well. This stock is up 1.5 rupees. So just once again, a flat opening for this one coming in. Well, TCS and Infosys, after yesterday's strong move on Infosys and TCS results expected tomorrow, we have TCS opening higher by 3.5%. Infosys, okay, still waiting for the first quote of the day, interestingly. So we'll wait for that. We'll look at some of the smaller stocks that we have been talking about in trade today. So let's look at Dena Bank, where QIP opens with a floor price of 30 rupees and 73 paise. We should also look at PSP Project, that one. Massive order, 1,600 crore rupees, and also Dixon Technologies that joins hand with Flipkart. So PSP is up 20%. We'll also get the next stock up on your screen, and also Bharti Infratel thereafter, where there could be a tower deal getting finalized anytime. That's the news flow really telling us. And also Lumex Industries, another small cap stock we are watching for after Ashish Kacholia bought into this company. This stock is up 13% in morning trade. Well, let's have a look at rupee. It recovered yesterday, and dollar index also softened a bit in yesterday's trade in US. So where is rupee now? Rupee has gained 5 paise further, 65.22. It has been moving in a range of 65 to 65.60. Remains in the range but higher. So second day of gain for rupee coming in here. Somit Sarkar is now standing by with the big brokerage calls of the day. Over to you, Somit.
So on the brokerages, first we have a City Research and Indraprastha Gas. Now they have maintained their buy rating and have hiked the target price to 1720 from 1390, which suggests a potential upside of 15%. Now they're expecting the City Gas Distribution Company's earnings to grow at a compounded annual growth rate of 18% over the 3 years. Now the brokerage has increased the value of new cities to 344 rupees per share to factor in the 3 new cities. That is Karnal, Faridabad, and the brokerage is expecting the company to win one more city in the upcoming bid. Now the valuations for IGL are expensive according to Citi Research, but they are not overvalued because it still does not factor in the full potential that full potential of contribution which is expected to come in from these new licenses that IGL has got. Now the key triggers for IGL going forward could be higher payouts, new licenses, inclusion of gas into GST and environment-led policy initiatives. Second, we have a CLSA on Axis Bank. Now they have upgraded the stock to buy from outperform and have hiked the target price to 620 from 600. Now, according to CLSA, Axis Bank's valuation are attractive and can re-rate as asset quality normalizes. Now, according to them, they're expecting normalization of asset quality to lift the return on equities to mid-teens over FY19 to FY20 from current 7% in financial year 2017. Now, they're also expecting stabilization and easing out of new stress loans formation from FY19. Now, the brokerage has also noted that Axis Bank's cost growth and cost-to-income ratio are higher than the larger private banks, and a reduction of 100 basis points in the same can lift the earnings of Axis Bank by 3% in financial year 2019.
Well, thanks, Amit, for all these details. On Axis Bank, it actually looks interesting. Mr. Chhaochharia, if you see, yesterday we were talking about Kotak Mahindra Bank crossing 2 lakh crore in market cap. So you look at the total overall book of Kotak Mahindra Bank and compare that with Axis Bank and ICICI Bank. So just like you talked about PSU and private, actually, even within the private sector space, market is not giving, good enough valuation to the corporate book. Are we at an inflection point really, going by this report from CLSA? Is it time to buy the corporate-focused banks like Axis and ICICI?
I completely agree with you and CLSA view because there are not many opportunities to buy stock, at attractive valuation. So in this scenario, banks like Axis gives you a lot of comfort because it is, in terms of price to adjusted book value, it is one of the cheapest among the large private banks. And second, the management has reported recently that the 12 big ticket, stressed assets which are referred to NCLT, almost 60 to 80% is secured. So that also gives a lot of confidence on Axis Bank share. So therefore, I would give a strong buy on Axis Bank.
Okay, so Axis Bank is a strong buy from CLSA as well as from Mr. Chhaochharia. And the country's largest reinsurer, that is GIC, General Insurance Company, will open for subscription today. That's a huge IPO. It's also going to be the third largest IPO ever in India. Saloni Dhanuka is standing by with all the details we need to know about GIC and the issue. Saloni.
Well, GIC will launch its mega 11,370 crore IPO today. Now, the sale will come in two halves. Firstly, the government will sell shares worth rupees 9,804 crores, while the company will raise another 1,500 crore by the way of fresh issue of equity shares. Now, it is in the price band of 855 to 912 per share, and it will be a 3-day offer for this IPO. Now, in terms of the business, it is the largest reinsurance company in India, which accounts for 60% of the market share and with 44 years of experience in this industry. The company operates its business across 161 countries with 30% of its gross premium coming from outside India. Now, a large portion of business comes from agricultural space, that is the crop insurance, followed by fire and then motor segment. Now, for GIC, major business comes from the non-life insurance players as well. In terms of valuations, GIC has a gross premium book of over 33,700 crore and it has seen a jump of over 82%, while the net worth for financial year 2017 stood at around 49,550 crores, and GIC also has an investment book of close to 69,000 crores, of which 55% is invested into equities and the rest is invested into central and state government securities. And in terms of operating metrics, the loss ratio, which is the claims incurred as a percentage of the net premium, stood around 81% for the year ended March 2017, while the net expense stood at 18.5%. And lastly, the solvency margin stood at 2.4 times as compared to IRDA mandate of 1.5 times.
Saloni, but you can't really compare it with a life insurance company listed in India or a general insurance company listed in India. This is the first reinsurer, so insurer of insurers, so to say. How do you really put the valuation into perspective? We have global benchmarks?
So when compared to global peers, it has the highest investment yield of 12.5% and it has the lowest expense ratio of 18.5%. On the flip side, it has the highest combined ratio of over 100%, which the company plans to reduce in short to medium term in the range of 95 to 100%. And in terms of valuation, when compared to global average, it has a price to book value in the range of 1.5 to 1.6 times as compared to 1.1 times for global peers, while the price to earning multiple for GIC stood around 24 times as compared to 45 to 50 times for global peers, which is much lower. And lastly, major broking houses like India Infoline, ICICI Direct, Prabhudas Leeladhar, Angel Broking remains bullish on this issue and they recommend subscribe for their investors.
Thanks, Saloni, for all the details. Mr. Chokkalingam, what's your view?
We have strongly recommended a subscribe rating on GIC. It's a very interesting data point you have presented. If you look at GIC, as your presentation says, it is around 40-45% premium to the global peers. But in India, if you have seen the pure insurers, they are trading, they are valued at 3 times embedded value when the global companies are traded at around 1 time embedded value. So the point I am trying to communicate is that as compared to the direct insurers, this reinsurer is available at a very cheap valuation on a comparative basis. So therefore, I believe one should definitely apply, and it's a long-term wealth creating stock in my view.
Okay, so this is a long-term wealth creation idea. You must apply for this one. GIC is the first reinsurer and also the third largest issue in the markets. We'll keep tracking this stock and also give you further updates on it going forward. We're also looking at some of the mid caps in the entertainment space. Balaji Tele is one interesting stock, and the stock has seen some interesting move, Mr. Chokkalingam, of late. Do you track this one? The company is actually meeting today and tomorrow. They're meeting big investors. There could be some action.
No, I'm sorry, I haven't tracked it in the recent time.
Okay, Vishwesh, by any chance, is it on your radar? Have you had an opportunity to look at the charts?
Which stock, Pradeep?
Balaji Tele is the one we are talking about.
Unfortunately, chart structure is definitely not that encouraging in my opinion, because the stock has been moving very erratic. I think in a shorter term, only one thing which I can comment is around 150 band. It has got a very important support, and if that holds, then stock has a possibility to move towards 175, and if 175 cross, then probably it can reclaim its high of 200 odd rupees. So 150 is a very pivotal level for the stock. With that, one can buy.
Okay. Well, markets have settled now, so let's look at what are the levels that we are actually looking at in market open today. Nifty, Bank Nifty should come on your screen. Market is opening positive. We are almost following the trend of SGX Nifty, like we thought. 10,040 to 50 is the kind of range where Nifty could open. So we're stabilized at 10,042. If you look at the Sensex also, 31,975, very close to 32,000 mark. Let's have a look at Bank Nifty also and see how that one is doing. Bank Nifty has been lagging behind Nifty of late, and also mid cap and small cap that have in fact led the rally over last two sessions, yesterday and day before. So we have mid-cap index opening higher by 80 points, 0.5% mark. That is good enough. And also we have small-cap index. Well, this is still lagging behind, but that's usual. In pre-open session, we have focused on some of the bigger mid-cap liquid stocks, then small-cap. So small-cap will probably start moving after markets open. We are just a few minutes away from the market opening, and we tell you all that you need to know to stay ahead in trade today. Well, GM Breweries is the first stock that should come on your screen. The company reported results after market hours. Company has recorded a growth in profit after 3 quarters of decline. So that is interesting. Goa Carbon, Kirloskar Pneumatic, Lakshmi Vilas Bank, Network 18, TV 18. These are some of the companies going to announce the results today. So we'll keep an eye on all these numbers. CLSA has upgraded Axis Bank to a buy rating from outperform with revised price target of 600 rupees. CLSA says the valuations are attractive and can re-rate as asset quality normalizes. You also have Coal India that signed a pact with National Coal Wage. Now the agreement may have an impact on the stock because it's roughly 5,500 to 6,000 crore rupees impact on books, what most brokers are expecting. JP Morgan says it's on the higher side and will require a price hike, that is a coal price revision will be needed. General Insurance Corporation of India IPO opens for subscription today. Issue price between 855 and 912. Meanwhile, the Indian Energy Exchange IPO was subscribed 43% on day 2. That was yesterday. Finolex Industries, Kalpataru Power and Balaji Telefilms will meet some big investors today, while Ashish Kacholia has bought stake in Lumax Industries. So these are some more stocks to watch out for. Well, we have seen a lot of interest in power segment, Mr. Chhaochharia, and like what happened yesterday with Adani Transmission, with the Reliance Energy, a likely deal with Reliance Energy. Now, how do you really see this development? Normally, what happens is there is an acquiring company and there is an acquirer. Usually, it's the acquiring, the acquirer loses in trade because people feel this is going to be, a bit expensive, strain on liquidity and all. But yesterday, Reliance Energy was positive, flat to positive, but we saw a circuit in Adani Transmission really. How do you really see it?
Yeah, very tough to answer because the valuation comfort is also not there for Adani Transmission. It is trading at abnormal PE valuation, and even the June results, if you see, there has been a dip in the PBT, profit before tax. Perhaps it has to do more with the speculative element associated with the floating stock. If you net out promoter stake and FI institutional holdings, what is available in the market is only 3 to 4%. So perhaps that explains abnormal rise in the stock price of Adani Transmission.
Okay. So that's the call. What really do you like in this sector, if at all? Because this sector has been an underperformer, but of late has started moving up. If you look at year to date, I think this is at least a market performer, if not an outperforming sector.
Rather, I would, as you said, I would buy Reliance Energy. They should be able to generate more cash and reduce the debt. So that looks very interesting. Apart from that, it's very difficult to find good ideas in the power sector. Maybe one can go back to only L&T. That still gives you a lot of comfort.
Okay, thanks a lot, Mr. Chhaochharia, for taking time out for us and joining us this morning. And now we are looking at the market open. As per our expectation, market is going to open strong, up by roughly 25 points. That is what Nifty also indicated. We'll have an eye on some of the heavyweights, especially Coal India, which is going to be a stock in focus after the wage revision, and a number of reports that we have seen. 10,040, 41. Well, that's good enough. 10,050 to 10,070 is the level that most analysts are looking at. But 32,000 plus on Sensex, that is interesting. And Nifty Bank moving up by 75 points, has been an underperformer. So holding on above 24,400. Nifty Bank, that is good. If you look at mid cap and small cap, they have been outperforming the indices, Sensex and Nifty, over the last 2 to 3 sessions. And today also Nifty mid cap has opened up by 0.5%, and BSE small cap is also up by 100 points. So that's good going. Let's look at the heat map. 80% Nifty stocks opening in green. That's a really strong positive indication coming in. You have Axis Bank leading the charts with positive reports from big FIIs. UPL was yesterday's smart gainer, is up today in trade as well. And then you have GAIL, which is leading at 2% with further hints coming from government on liberalizing the gas pricing. There could be some impact there. ONGC, NTPC are two more stocks that are quoting higher, stronger. So PSUs are really supporting market this morning. Maruti, Dr. Reddy's, Yes Bank, these are only a few stocks which are in red. Actually, if you look at it, Nifty is inching up, and you could also see some of these stocks that were in red, till a couple of seconds back are now trying to turn green. Like ITC has moved up, Coal India is moving up, Z is also trying to move up. So that's interesting. Early trade really looks positive, but look at some of the mid-cap stocks that we have already discussed today. Look at Dena Bank. What happens to that one after the QIP offer and floor price announced at this one? Dena Bank is up 3.5%. So that's a good going for Dena Bank this morning. And Lumex Industries, the stock where Ashish Kacholia has bought, the stock was up in pre-open. What is happening now is up 6% now. Lumex Industries quoting at 1544. So that is really the level we are looking at. PSP Project, another stock that we talked about in mid-cap space with the huge order coming companies' way. The stock is up 11.5%. That's good going for this one. So these are some of the stocks in mid-cap space. So mid-cap and small-cap continue to lead. Sensex and Nifty have opened higher and are inching up. That's again a positive sign, even from the key indices. Vishwesh, how do you really see the opening now in Nifty and Bank Nifty, and what are the next level to watch out for in both these indices?
See, I think, Pradeep, we are at a very, very critical level. In my opinion, 10,060 on the spot happened to be a very critical level, because if you recall, on the day when we were falling, somewhere, if I had to pinpoint, that was around, last 20th September type. And from that day, which was a low of around 10,058, Nifty fell almost a 200 point in a single day. Now, if you see the last 3 days price movement, you are going higher with a narrowing candles. So your price range are narrowing, so that means the momentum is dying, and around this 10,060 odd level right now, spot is around 10,040, only 20 points away. If the momentum dies out and the short sellers start dominating, then in my opinion it will be a big dent. So I am very, very cautious at this level. I would not want to go very aggressive in terms of buy. On the other hand, I would want to watch very carefully what happens. So volatility is again, India VIX is around 10.86, so now long volatility becomes a stand. So you have to understand, Pradeep, volatility is a mean reverting process, and right now you are at the range which may be a lower end of the range. So if you long a volatility, then probability is already in your favor, and if the market also turns, then it will be favorable. So buying options right now would be cheaper because of the cheap volatility, and you are gaining both in price and volatility terms. So as an option trader, I would like to wait and watch, and want to create some short position in index. I would want to create some long volatility strategies.
Okay, so if volatility is rising, it's time to buy options rather than write options. That's the strategy. Vishwesh, thanks a lot for taking time out for us. And now a very special guest joins in. Gautam Chhaochharia, Head of Research at UBS, is joining us. So Gautam, good morning. Thanks for joining. All eyes on results with TCS and IndianOpen Bank coming tomorrow. Well, if you look at the last quarter numbers, in fact, market kind of peaked if you are talking about, Nifty or Sensex towards the end of July after, we saw the quarterly numbers. Will this quarter give us any relief to markets?
So this quarter, good morning to all of you. This quarter is a bit tricky given the impact of GST and how it could impact the reported numbers. It's difficult for us to be sure how the reported numbers will be interpreted. Having said that, if I look at street expectations per se, there is some level of positive impact from restocking being built in into estimates for second quarter. But what I would say is two things from a market perspective. One is the implied growth rates for second half is still way too high. So if the Q2 estimates, which is kind of building in GST restocking benefits, is delivered, the implied growth rate in earnings for second half is around 19-20%, which seems stretched to us, and which means there will be further earnings cuts ahead. Secondly, from a market's perspective, what would matter is the management commentary in context of how they have seen demand trends, specifically in the month of September and October. So the reported numbers will obviously be impacted by supply chain issues around GST, but the underlying demand trajectory, specifically around September, October, would give markets some sense of direction about what could happen in the second half. Now, normally we do know that corporates are always optimistic, specifically about second half, but the commentary I'm talking about is specifically around what they are seeing in September, October, and that will give a good sense of direction, and that will possibly set the tone for market trajectory, because second half recovery is again, just like 3-4 years, is the big hope trade for markets right now. And if you don't see that playing out, that would be a big negative surprise for markets here on.
So we do have some high frequency data really to work with, like auto sales numbers or the core sector growth, things like that. How do you really see these numbers, and doesn't that support the kind of optimistic projections we have for second half?
So in our analysis, no, because we've been tracking this high frequency data regularly over the last few years. And as you've seen over the last 3 years, at any given point of time, there are few data points which always seem optimistic and few data points which seem suggest that economy is not in a good shape. So even now we are seeing a mixed bag. If you're talking about car sales and two-wheeler sales, they've been reasonably positive for a while, including in the first quarter when the GDP print was 5.7%. And there's also the variability because of base effect, etc. So we have seen in many core industry data, the monthly data points are quite volatile. So you could have a period where the last year's month growth rate was in the negative territory, and you see a good Y&Y print in this year's data. So what we typically look at is disaggregate and aggregate and try to smoothen it out and see the underlying trajectory about what they're suggesting. So to us, it still suggests that the economy is in a similar shape as it was 6 months back or 2 years back, which is broadly okay, but no sign that it will go up in a hurry, and no sign that it's going to be in a very weak state as was being speculated by the market about a month back.
So I understand that you have cut your earnings expectations of late. What has been the extent of this cut?
So we are always expecting earnings cuts to happen throughout the year. We just incorporated the impact of GST into the expectations. So we are now expecting earnings growth rate of 6-7% for fiscal year 18 and 12-13% for fiscal year 19. Okay. This is a top-down forecast. The analyst estimates can vary. Okay.
The sectors we have been talking about, IT is always the first that one looks at, because TCS will come out with the numbers. Infosys, of course, has deferred the numbers this time around. What are you expecting? Could there be some positive surprise? I mean, in any case, this is not an over-owned sector as of now.
So can't comment on individual stocks, but yes, IT services numbers will likely be muted. But the key point here is that the expectations are already building that in. And we were negative on IT services sector for last 3 years. We didn't have a single buy rated name, but a few months back we did turn tactically positive. As the point you mentioned, it's under owned, valuations are reasonable, and more importantly, expectations are quite low. So for example, even in the first quarter where the numbers were not great, they didn't surprise markets negatively. So even for the second quarter, our view is that the expectations are quite realistic. And numbers, while they may not be great, but unlikely to be a negative surprise. And at the margin, if the commentary has positive undertones, specifically from some pickup in US spending, that could be at the margin a positive. So tactically overweight, but yeah, the structural concerns still remain. And there are individual ideas which we're still comfortable with recommending here.
Well, banking is the next sector with IndianOpen result also expected tomorrow. Again, I'm not talking about the stock per se, but the sector, if you look at, will private sector results be as good that justifies the valuations that we currently have for both private sector banks and NBFCs? And will PSU numbers, will they be really so bad?
So it looks like the trend will continue in terms of retail-focused private banks doing better than corporate-focused private banks, and definitely doing better than the SOE banks. Even NBFCs should be in a better shape. So we do expect some moderation in the mortgage finance given the data points we have, but they should still deliver robust top line as well as earnings growth. And even the private banks, even the corporate-focused private banks, while we could see muted earnings, there is a possibility of provisioning coverage ratio that could improve further in this quarter. And that's the trajectory which we would like to see continue for a while, and then these stocks could become interesting.
Well, Dena Bank has come out with the QIP. A big question is whether the market really has an appetite for PSU bank papers. What's your assessment, and what happens? There could be more such offerings due.
So yeah, it will be very interesting because recapitalization of SOE banks is an important element of broader macro from fundamental perspective as well as market trajectory. And it's tough for me to say right now whether there's enough appetite for the kind of money is required. But yes, on the face of it, the valuations are attractive. But if you adjust for all the asset stress issues, then it depends on a specific bank. But then the valuations may not be as attractive. But yes, if they manage to get the recapitalization money, then the bank's balance sheet also improves. So it's kind of a chicken and egg story, and therefore a fairly interesting one for us to track, and would be an important data point and barometer for the broader macro and markets also going forward.
So like you mentioned earlier, overall the implied growth is actually too high and there could be significant earnings cut going forward. Are there particular sectors where you think that this risk is probably significantly high?
In our view, top-down view looks like quite broad-based. So except possibly IT services and possibly metals and mining, the risk is there in every sector, from consumers to autos to financials. Cement clearly stands out, and even industrial cap goods stands out in terms of earnings cuts potential. But it looks like quite broad-based. It will be quite a broad-based cuts across the street, across the sectors.
If you were to pick one or two sectors where you think results will be quite good and maybe there could be a potential revision upwards, which sectors would you really pick up?
So metals and mining could be one. Then auto two-wheelers could be another area where we could see positive surprise.
Okay, metals, minings, auto and two-wheeler. If you look at metals, really, the stock prices have moved up quite a bit, and stock prices generally track the commodity prices. Now, because commodity prices are kind of peaking, if you look at the trend over the last few weeks, and there are calls, we have seen some of the reports from top analysts who think that these commodity prices may not be sustainable. Now, what is the impact on stocks, earnings and valuations, and what would be your call on this sector?
So top down, we are neutral on the sector. Our view is also that the best is behind us in terms of re-rating potential, in terms of earnings growth potential. So unless we see a repeat of last decade's commodity super cycle, this sector best seems to be priced in already. Best seems to be behind us. So we won't be chasing this sector aggressively in a broad way. Select names could be interesting. But even in individual names, most of them, the risk reward is not attractive to buy at these levels.
Okay. And to talk about capital goods, you do see some stocks doing better this quarter?
So again, there are always companies here and there who deliver well because of market share gains, because of specific segments, etc. But a broader capital goods infrastructure, our view has been and still remains, there's no capex cycle recovery. And only where pockets where we see activity could be areas where we could see sectors and stocks specifically doing well. So for example, last 2-3 years it was roads, to some extent railways. Going forward, we could see some more activity in urban infrastructure, specifically metros. So those stock sectors can do well. But otherwise, in a broad basis, we don't have any visibility on private capex cycle in the foreseeable future.
But do you expect power stocks to perform better in terms of earnings?
So power is a more defensive space. So if you look at the power utilities specifically, they are more defensive. So their earnings is linked to capacity utilization, the size of the balance sheet, which they have been delivering, but the stocks are now fully pricing that in. So they are more defensive characteristic stocks. So they should be okay. But we don't see any real positive surprise potential from a utility perspective. The power equipment guys, absolutely, we do think the risk reward is unattractive here because they are pricing in some level of recovery in the foreseeable future, while in our view, we don't see any power capex recovery happening soon.
Okay, so you are playing the consumption theme through auto stocks like you mentioned. What about FMCG? There was significant destocking in that sector as well. What have you picked up through your channel checks? Would this quarter now be better?
It should be better. So for a broader consumer sector, we do expect 7-8% volume growth in this quarter on a reported basis, and there will be companies which will surprise more positively on this count. So yes, this could be an interesting quarter for that sector.
Gautam, personally, you have had a really strong track record for picking up mid and small cap stocks. At this point of time, this segment is probably quoting at record high valuations. If you look at the premium between large cap and small cap to mid cap, what's your call really on this sector?
So as a sector, clearly, in fact, we've been wrong for the last few months because we thought valuations are in the frothy territory. But the sector has kept on outperforming in general. So I'm not comfortable in terms of risk, reward and valuations for the broader sector here, and would recommend a lot of caution on this asset class. But as always, there are enough individual stories which still seem attractive and which still don't seem to be pricing inadequately the growth opportunity which is ahead. So individual stocks, there's still ideas, but yeah, as a broad category, I would advise caution.
But what do you really think is driving this segment? Is it because money is flowing into domestic funds and specifically into mid-cap funds, so the fund managers are kind of forced to buying, or what really are the factors behind this?
Absolutely, that's the only factor. At least in my view, fundamentals don't justify the kind of move we have seen there.
But there is also a logic that maybe in the short term there could be some correction because these stocks are quoting at a premium, but net over 3 to 5 years time frame, mid caps will still continue to outperform. So let us put more money into this segment itself. If you had to advise a retail investor, would you ask him to stay away from mid cap or kind of reduce the exposure to mid cap schemes and then wait for a correction?
So, I can't advise retail investors, that's not my mandate, but yes, in our client base, I do advise caution in terms of entering the small mid caps at this space. If you have it and you entered at a good price earlier on, you could still bet on holding on to these stocks from a 3-5 year perspective. But buying at these levels and hoping to make risk-adjusted good returns, even over a 3-5 year period, that seems an unattractive proposition to me.
Okay, well, one last question probably. IT is one sector you said is under-owned, and therefore you are turning a bit positive on that in terms of increasing exposure a bit. Would you have same views on pharmaceuticals?
Selectively, yes. Top down, we are still neutral on pharmaceutical as a sector positioning. But we do see select opportunities in a couple of stocks. But the broader sector will still advise to be careful and not get into the attraction of bottom fishing. It's still not in real value zone. They look attractive versus recent history, and the visibility on the US generics business is still not completely clear, still clouded. So only selectively look at ideas in that space.
Well, thank you so much, Gautam, for taking time out for us this morning. Nifty, in the meantime, is inching towards 10,050. Okay, it's above 10,050 really, and Nifty Bank is close to a century, up 97 points as we speak. But we slip into a short break. But up next, we discuss the government's Power for All goal with NTPC's Kulamani Biswal. And on IPO Adda, Alice Vaidyan of GIC will tell us about the reinsurers' futures plans, and if there is a revival in the country's core sector. We ask AK Garg of L&T Construction and Mining.
Are we live?
Programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Indian Open. Core sector activity in the month of August grew at its fastest pace this fiscal. The 4.9% growth was led by strong growth in the coal mining and the electricity segments. We're joined now by Mr. A.K. Garg, EVP and Head of Construction and Mining Business at L&T, to give us a sense of what's happening in the construction and mining segments of the economy. Good morning, sir. Thanks so much for joining us. So, essentially wanted to understand from you what's been happening on the ground, particularly on the mining side. I think apart from the core sector numbers which I referred to, we've heard anecdotally as well the demand for some of the mining related heavy equipment has started to pick up. Have you seen anything, sir?
Yeah, good morning, and it's nice to be on your show. As you said, we see that the coal mining sector is growing, and it's growing by almost about 6% per annum now. And there's a target of reaching 720 million tons of coal production this year. And we are seeing a lot of pickup in the demand, especially from the PSUs. Both Coal India and Singareni are doing everything possible to scale up the production. They are also engaging a lot of contractors now to ensure that the overburden is removed. And we expect that almost about 1,700 million cubic meters of earth will be removed to expose coal. This will help them reach their target of 1 billion tons of coal production in the next 3 to 4 years. So on the ground, there's been a lot of activity. They're also planning a huge amount of capex. And I see that there will be a great amount of traction in the coal production, especially because India is dependent on coal for energy, and 60% of our electricity production comes from coal, which is the most cost-effective means of producing electricity.
So, what you're describing, of course, is the long-term objective, particularly on the coal front. But there have been conflicting numbers. So, for instance, I know that the September numbers showed that imports of coal had to pick up because there was a shortfall on the domestic side. I'm just trying to understand, say, over a 6-month odd period, have you seen any ups and downs in the mining side, sir?
See, we are seeing that this year, definitely, there's almost a 5% growth over the previous year in the coal. In the cement sector, of course, we see that it continues to be flat, though certain companies are trying to improve the capacities, are putting in new capacities. But still, the capacity utilization is only about 70-75% in cement. In coal, we are definitely seeing a lot of movement taking place, and especially the coal subsidiaries are going in for a large number of equipment purchases. And as I mentioned earlier, overburden removal is a continuing activity where a huge amount of contractors are being deployed to expose the coal seams.
Are you seeing this, sir, only across coal or through the other mining sectors as well? And has it translated into more orders for you? Can you quantify that for us?
Yes, I would say that in the cement sector, we are seeing a lot of traction, especially the large companies like Shree Cement, Ultratech, and the Lafarge Holcim. They are going in for capacity expansion. As you know, there's a lot of consolidation taking place in the cement industry, and the large players are moving towards increasing their capacities because they expect that the cycle will change and that there'll be a big demand, especially for cement, coming from low-cost housing and from concrete roads that the government intends to build. So there's a lot of traction in the cement sector. Iron ore sector continues to be a little dull, but still they will also reach about 170 or 200 million tons of production this year.
What has all of this meant in terms of increased orders for you all at L&T, sir?
For us, we will be getting equipment orders worth about 500 crores this year, and this is a growth of almost about 10 to 12% over the previous year.
So a bit more on the construction side. So is the activity still largely coming in from housing? Is there any traction building up on the infrastructure side at all?
In construction, actually the force that is driving construction equipment is roads, because as you are aware, they are now reaching almost 28 kilometers of road building per year, and they have a very, very large target of building or awarding orders for 20,000 kilometers of roads. So the primary sector that is driving the construction equipment is the road sector. It is followed by low-cost housing, quarrying, and railways are also now picking up, and the government has an intended order book for about 7,000 kilometers is what they want to produce cement to build railway lines this year. So all these sectors are giving us a lot of activity. And after Mr. Gadkari has taken over as the Minister for Rivers and Waterways, he's also now talking about river linking. That will also be a big, big driver for the construction equipment. In construction equipment, the last year was very good. We almost had a growth of 30% plus over the previous year. And even in the first half of this year, the growth has been about 12 to 14% more over the previous year.
So, in a previous answer, you were talking about capex. So the understanding was, and this is something that had been said in a report yesterday by one of the rating agencies as well, that the capex will largely be in the form of maintenance and upgrades. But you're saying that there is some segments such as cement where fresh capacity is also coming in. I make that distinction, sir, because the sort of, the orders coming in from fresh capex and maintenance capex would probably be very different, right?
Yeah, so in Coal India, it would be mostly the replacement. So it would not be really maintenance, but what would happen is that equipment that was purchased earlier would need replacement. So there it would be replacement. But in the cement sector, many companies are setting in fresh capacities. For instance, Sri Cement is setting up greenfield projects in Karnataka and elsewhere. So it is also fresh capex that is coming in the cement sector.
So just one last question. I'm sorry, I don't know what percentage of your segment's order book comes internationally, but can you give us a sense of whether there is any change there, particularly the Middle East markets, which in the past had been weak?
See, in our case, for the construction and mining machinery business, we are focused on India and we are not really looking at the Middle East. So for us, it's all about serving our customers in the country. All
right, Mr. Garg, thank you so much. Great to have got your thoughts on what's happening on the ground. That's AK Garg of L&T.
All right, it is 9:45. GIC is the country's largest reinsurer and is looking to raise more than 11,000 crore from the primary markets, making it the third largest IPO ever in India. We've got Yatin Mota and Saloni Dhanuka, both the BloombergQuint, standing by with the company's chairman and managing director, Alice Vaidyan, on IPO Adda.
Hello and welcome to BloombergQuint. You're watching IPO Adda, and today we are joined by Alice Vaidyan. She is the CMD at GIC, one of India's largest insurance IPOs. Ma'am, thank you so much for joining in. If you could, tell us, in terms of the investor response, since it's a very large, reinsurance IPO, so far in the investor roadshows, how has been the appetite for your paper?
Yeah, Yatin, I should tell you that we are very happy with the response that we have received, both from international and domestic markets. In fact, we are very excited because we have seeing a lot of foreign investor and domestic investor interest in the IPO. Probably it's also because it's one of GIC as a reinsurer is in a very different
Mr. Biswal, can you hear me? This is Menaka at
a non-life
BloombergQuint.
insurer or a life insurer who has already hit the market before. As a reinsurer, and that too as a government-owned entity, and that too as one of those large companies to hit the market, I think we are well positioned, and I think this is a very good opportunity for GIC as a government company to unlock its potential.
Also, ma'am, the company has a gross premium book of over 33,700 crore for the year ended March 2017, of which 30% is contributed by overseas business. So, ma'am, how do you manage your foreign exchange risk, and what kind of an impact do you see on your books?
See, we write out of 161 countries. And we write in 141 currencies, but then we don't have much of a foreign exchange risks, because the downside in one currency often offsets the upside in the other. So we have not faced any foreign exchange currency risk last year.
Okay. Ma'am, in terms of the competition, when you talk about the overseas business or the domestic business, since you are a very large player also in the overseas market, if you could tell us how is the competitive landscape, in the marketplace? Have you been able to overcome competitive forces in order to grow your book profitably?
Are you talking about international markets?
Yeah, both domestic as well as both domestic and international. Of course, the international market would be intense in terms of competition.
Yes, yeah. See, in the Indian market space, we don't have any competition at all. We have been the sole reinsurer in this market for 45 years. We know the market well. We know our business. We know all our clients. We are very confident about the dominant 60% market share we have in this market. And I think going forward, even if the branches of foreign reinsurers which have opened now were to enter in a big way, we don't see any competition at all, because it's finally what the market respects is the long-term commitment which we have demonstrated to the market in all these 45 years. Now, if you're talking about the international market space, you know what, we have branches in 5 countries: London, Dubai, Malaysia, Moscow, and South Africa. And we write business out of 161 countries. Mainly business is sourced through intermediaries or brokers. So what we need to write business in these countries is a rating which we have, A- excellent by AM Best. We have market stature as the 12th largest reinsurer in the world. We have a very strong balance sheet. We are a multi-line reinsurer. We have gross premiums of 5.2 billion in the international market. So we have not faced any challenges sourcing business in the international markets as well.
Also, ma'am, a large portion of your business now comes from crop insurance space. So do you see any concentration of risk there?
Not at all. See, right now, crop insurance is just about 29% of my book as a segment, if you see. And there was a huge growth last year. But going forward, I think that growth is only going to stabilize, and we don't see any concentration in any risk. Probably GIC is in a very advantageous position, given that we have the most diversified book in the Indian market. Like I say, we write across the country, across all the states, across all the companies that write crop insurance, and across both the crop seasons as well. Probably no reinsurer could have asked for more diversification in any country, and that gives us a lot of strength in this market.
Also, ma'am, do you see increased competition from the foreign players who have set up their reinsurance business in India?
Not at all. Like I said, all these foreign reinsurers who have now opened offices, they were anyway writing business in the Indian market from outside of India, and they had a 50% market share as well. So now that they have opened office, there is room for everyone to grow in this market, and we don't see any threat or competition from these big reinsurers who have set up offices in India.
Okay. Ma'am, one last question from my side. In terms of the overall growth drivers, you are present in multiple segments, as my colleague was mentioning, from crop insurance, fire, a lot of segments. Moving forward, which are the segments wherein you see good growth coming in, good margins coming in, and if you could take us through the kind of business opportunities that you could see moving forward in terms of new products or new segments also.
Yeah. See, India is in a high growth phase. So we probably foresee a landscape where all lines of business are going to grow at a fast pace. Direct market is already growing at 20 to 25% growth pace, and crop insurance has seen a leap last year. The motor insurance is anyway 40% of the market in the Indian market. Health insurance is going to grow in leaps and bounds going forward. And we are talking of a 1.2 billion population in this country and under penetration levels of 0.8% for non-life in this market. So I think this growth is going to continue for a long time to come in the Indian market.
Okay.
All right, ma'am. Our last question to you would be, in terms of financials, the combined ratio for general insurance which is over 100%. Now it measures profitability of an insurance company, and as per the definition, a number over 100% indicates that the insurer is not making any money out of the premium collected and they completely rely on their investment income. So ma'am, how do you plan to bring it down?
Yeah. See, if you see GIC's combined ratio, it has been coming down consistently over the years. And last year we have recorded a combined ratio on a standalone basis within 100%. For the first quarter also, it has been within 100%. So that is the single most focus in GIC. We wouldn't want the investment income to subsidize our operations. And we also believe that as a reinsurer, we set higher standards for ourselves than the market. And we would definitely aim to have a combined ratio within 100, and that should be the operating profit should be a natural hedge to the business. Yeah.
Okay, thank you so much, ma'am, for speaking to BloombergQuint, and all the best for your IPO. So that was the management of GIC, very confident about growth prospects when it comes to the Indian market, as well as the management sees a good opportunity and is planning to get a good share of business from the overseas markets as well.
All right, that's the giant IPO opening today. Let's move on now to NTPC. The government's revamped Power for All scheme, or Chhaochharia, could increase electricity demand over the next 2 years. The country's largest power producer, NTPC, will be a key beneficiary if that happens. For more on that and other demand indicators, we're now joined by the Director of Finance at NTPC, Kulamani Biswal. Good morning, Mr. Biswal. Thank you very much for joining us here at BloombergQuint. Let me ask you about the quarter that's just wrapped up, sir. In terms of how you fared in the quarter, the power demand or electricity demand for the last couple of months seems to have been looking up. Is that what you would agree to as well? What have plant load factors been like? And let me add to that, what kind of uptick you expect from the Chhaochharia scheme in the quarters to come?
Yeah, last quarter has been very much exciting so far NTPC is concerned. In August, our energy growth was 12.55% as compared to corresponding month of previous year. Similarly, we registered a growth of 6.25% in the month of September. On quarter-on-quarter basis, that is a growth of 7.35%. If you see, look at the PLF in the first half of this year, we have registered a plant load factor of 77.98% as compared to 58.79% of all India figure. So NTPC is always maintaining a spread of 18 to 19% over all India figure. So we are very much optimistic with the implementation of this Chhaochharia scheme that energy demand will grow. And when the country is expecting a GDP growth of 7% and power has to keep at least same pace, at least the power sector will grow at 7%. So we are expecting a generation growth in balanced part of this financial year.
Sir, I know it's very early at this point in time, but is there any way you could quantify, given that this is the last mile push under the Chhaochharia scheme, any way you could quantify what it would mean in terms of additional power demand in the country, what it would mean for power generators like you all?
You see, recently, Honorable Prime Minister has launched this Saubhagya scheme. Basically, this government is going to spend around 16,300 crore, 320 crore towards the last mile connectivity. As we see, although 96% of the villages have been electrified, but around 300 million people, they don't have accessibility to electricity. This scheme is launched to give last mile connectivity to the willing consumers, both urban as well as rural consumers. And definitely once the connectivity is given, the demand will grow. And it is very difficult to assess at this time, but we can say at least in the rural India, the demand will pick up, and NTPC, so far NTPC is concerned, once the demand is there, our PLF will go up.
What has been the capacity utilization in the first half of this year? If my data is correct, you've added about 1,800 megawatts. Is that correct?
Yeah.
But that's much.
So for capacity addition is concerned, we have added around.
Sorry, the point I was trying to make is that that's much lower than what the expectation was for the full year. You've had a dramatic target for capacity addition for the full year. Are you on course on achieving that? Can you give us what the updated numbers are?
Yeah. Our target is for capacity addition, we are we will be adding around 5,000 megawatts so far capacity addition concern, and around 4,000 megawatt will be commercially operated this year. And we are on track, and we are optimistic, we are hopeful that we will meet our target.
So you've done 1,800 crores of that 5,000, and you're hoping to do the rest, which is about 3,200 megawatts, not crores, sorry. 3,200 megawatts by the end of the year.
Yeah, CapEx. Yeah, our capex target is 28,000 crore, madam.
No, sorry, I didn't mean crore, I meant megawatt. My apologies for that. You're saying that you will be able to do the remaining 3,200 megawatts by the end of the fiscal.
Exactly.
All right. So one other question that I did want to ask you, and this had to do with, the fixed cost pooling exercise that you all have been talking about for a long time. Is it finally anywhere close to operationalization? What kind of impact could it have on your financials?
So far NTPC is concerned, this will be revenue neutral, but this will reduce the tariff burden of the states, and we have a target. We are hopeful that it is going to be implemented on 1st April 2018.
Mr. Biswal, while you talked about achieving your expansion goals,
NTPC.
Okay, sorry. Please do complete.
Yeah.
So you were talking about achieving your.
So far, this no, just that was a question on this. Yeah. Regarding this fixed cost pooling tariff, we are going to implement it. Say 1st April 2018 is our target, and so far NTPC is concerned, we are revenue neutral. We are not going to be benefited out of the scheme, whereas all the states will be benefited.
Okay. Mr. Biswal, while you talked about achieving your expansion goals by the end of the year, what we see is your capacity is probably growing much faster than the pace at which demand is growing. So what is the risk that by the end of the year, you'll probably end up with lower plant load factors than what you have now?
If you see worldwide, we are in a better position. That plant load factor of 78 or 77% is not low. And the plants, whatever capacity we are adding, looking at if you see the future demand of the country, and if the country is growing at 7% or 8%, the power has to grow to 7 to 8%. And no private sector is adding capacity. You may see in the last few months or years, nobody is coming forward except NTPC. So these capacities are added to meet the future demand of the country. And so far NTPC is concerned, we add capacity only when we have long-term PPA. So even if the capacity is added, there is no revenue impact as fixed cost is recoverable from the beneficiary.
So just a couple of last questions, if I may. A few months back, there was a proposal doing the rounds that NTPC would play a role in the stressed power segment, in the sense the proposal, we believe, was that a lot of these stressed power assets would be pooled and NTPC would run them. Then we didn't hear anything about whether that actually fructified or not. Is there any discussion on NTPC playing a role in the stressed power segment, sir?
Initially, we gave an option that we can play a role of operation and maintenance of those plants if it is acquired by the bankers. Now we are thinking that we come out with some expression of interest, and we are going to devise a transparent process of acquiring few stressed assets, and which are in well conditions. They are well engineered, and basically they are 500 megawatt capacity and more. So look, we are looking for few assets being in good conditions, and very quickly we will come out with some expression of interest.
So you have identified these projects. Are they the ones where companies have gone into insolvency, where banks have taken these companies to insolvency? Are they from that pool, sir?
Oh, no. We actually, it is open. We initially will make certain terms and conditions. In general, we are not eyeing on any specific power plant, but we will bring out some expression of interest with some terms and conditions that favored NTPC. And whoever is falling within the norms fixed by the NTPC, they can apply.
Have a set amount of investment that you're willing to make to pick up these stressed power projects, sir?
We have not quantified the size of investment we are going to put there. That is open now.
All right. So I'm sorry, I'm a little confused yet by what you're trying to tell us. Are you saying that you actually are looking at operating and maintaining some of these stressed power assets? Is that how it works? Or you're asking them if they want your help in some fashion?
At the same time also, no, there are two parts. One is operation and maintenance, and we are open to take over operation and maintenance of the plants if it is taken over by any financial institution bankers. That is one part.
Okay.
Second part is, if at all we are going to acquire any stressed assets, we have to acquire those assets through a transparent process. We may come out with an impression, expression of interest very quickly for those assets.
Okay, so if you were to acquire, have you allocated a certain amount of capital towards that already after discussions with the government, or is it still very open-ended?
So far, NTPC is concerned, it is open-ended. I clarify that. So far, we have in 28,000 crore, whatever capex we have given to the government, assurance to the government, commitment to the government, that does not include any acquisition cost. Moreover, if any assets we are going to acquire, NTPC has strong balance sheet, immediately we can arrange funds.
All right. So I have a question on tariffs.
Fund is not a limiting factor so far NTPC is concerned.
Yeah, sure, no problem. I have a question regarding tariffs. Now, I know that you generated some of the lowest tariffs in this country when you looked at pooled costs, etc. But we've seen a downward trend in tariffs in the renewable sector. Some of it is spilling over into traditional PPAs as well. What is your outlook on where power tariffs are headed? Given also that we've seen, I think, some reduction of the GST on coal. So any clarity that you can help us, help give us on that will be great.
Yeah, with the introduction of GST, the coal previously, the taxes on coal was around 11-12%. It has reduced to 5%, so it has impact on tariff. At the same time, also some of the capital expenditures and other O&M expenses, that tariff, that annual service tax, it has gone up from 15-16% to 18%. So that was upward trend there. So taken together, the power impact would be 2 to 3% upside as far as power cost is concerned. Presently, we are taking all steps to reduce the power cost. Our, if you see, NTPC is one of the lowest power generating company. Our cost of generation is 3.19 rupees presently. And we are trying continuously to reduce the cost. Recently, government has allowed us flexibility in terms of coal transportation. We can utilize coal from the nearest mines. We are trying to reduce the transportation cost and trying to consume coal from the nearest mines so that a variable cost is reduced. We are going for ICV for our capital expenditure so that the ultimate capital cost is reduced. So NTPC is taking all steps to reduce per unit tariff so that consumer gets affordable power.
But since you're a regulated entity, this doesn't help benefit your margins in any fashion, does it, sir?
Yeah, it does not reduce my margin, and only in case my PLF is improved. And if some of the plants, what we are trying, we are the plants which are near the pitted, we are trying to improve the PLF, those plants beyond 85% so that we can get incentive. At present, as per the regulation, we get 50%, 50 paisa per unit incentive if we generate power more than 85% of PLF.
Are you confident of being able to meet that? Because I think in the first quarter this year, you did roughly 79% of PLF. You just told us your average for the first half was about 77. So I'm assuming that the second quarter PLF has in fact lowered. Do you believe that you'll manage to cross 85 through the year, or have I got the numbers wrong?
Ma'am, this is average PLF of the NTPC, but incentive is allowed plant-wise.
Okay.
So there are certain plants which generate power more than 85%, and there are certain plants which generate less than 70% as per the demand. So we are trying to improve PLF for those plants which are pitted plants and their variable cost is very low.
So what is your expectation of where PLF will be by the time the fiscal ends, given the experience of the first half?
It will be at the at least our PLF would be higher than previous year. That is, it will be around 78-79%. If you see year as a whole for this FY 17-18, PLF would be, so for NTPC is concerned, it would be 78-79%.
All right, Mr. Biswal, if there's anything else that you'd like to update us on the months to come, that's great, because otherwise I think we've managed to put every question we had to you.
Pardon me?
I just wanted to check if there was anything else that you would like to update our viewers with in the months or quarters to come. Otherwise, we've put every question we had to you.
No, it's okay.
All right. All right, Mr. Biswal, thank you so much for joining us this morning. That's Kulamani Biswal, Director of Finance at NTPC, talking you through what's likely to be a good demand second half of the year. With that, we're wrapping it up here on Indian Open. Up next is the FNO Show.